And so the business is, if they can get a lower, even a half a point lower on an interest rate on a 30-year note or something, it's really going to change the amount of money that business has to pay. And so that is a way to induce the businesses to take out these loans. But if you also think about it, so let's say the restaurant wants to take out a loan because the interest rates are lower. And what they want to do is they want to add on another room to seat people. Remember what I said earlier, that if people are refraining from buying lumber and stuff to build right now, there's a surplus. And what does that do when you have a surplus of materials in the economy? It drives the material cost down. And so the business benefits from a low interest rate and low materials costs when there's a time link between the consumers and the business. Now, at some point, the consumers say, okay, I'm ready to begin consuming again. And now, hopefully, the business has completed its capital investment, and now it's ready for this added market share. Now there's going to be more people purchasing in the present, and that added market share, if the business chose wisely, should increase performance. Now, as the more and more people take money out of the banks to begin consuming again, the banks tend to raise interest rates. They could, if in a normal free market, they would raise interest rates, and that would tell the businesses that, look, consumers aren't saving for tomorrow, they're spending now, so it isn't in your best interest to do long-term budgeting. And so, if you think about production, the producer good industries like mining, refining, grain production, those are most most sensitive to interest rate fluctuations. And so that part of it is because of really high cost of not necessarily labor as much as capital goods, the mines and all the equipment and things like that. Now, during the Depression, investors were led into poor investments, and those would also be true here in the last few years. We got the dot-com bubble relatively recently. We have the housing bubble, right? So because there's no time link between the interest rate doesn't link the consumer and the producer, it's fixed by the Federal Reserve. More and more businesses are being led into malinvestment trajectories, just like the Great Depression. Now, what happens when the Fed lowers interest rate instead of letting the market do it? When the Fed lowers it, you're going to have consumer spending at current levels. The thing is that you're going to have businesses that are saying, man, these interest rates are low, this would be a great time to add an addition onto our restaurant or whatever, so businesses make capital investments, but there's no time link, right? And so since consumers aren't saving, they're consuming at the current levels, and the businesses start taking out loans, what you find is that there's fewer materials in the market. There's a materials deficit, and so that's going to lead to cost overruns, poor investments, etc. What's also troubling is that some of those resources are permanently lost. So you have cost overruns, but also you can only build so many houses. So if we're talking about building on a restaurant, and I'm going to add on to my garage, and there's only at that point there's only so many bricks in the economy, and not everything can get built. Maybe there's not enough bricks for both of us to finish our addition. So let's review. What initiated the downturn in the economy in the Great Depression? Well, 20s were booming, right? But because the Federal Reserve was altering the interest rates, what was happening is you were getting widespread malinvestment. And so the boom is actually the disease. And so you do get this artificially booming economy. But then the cure is this crash that comes after, where the market has to readjust and liquidate some of the assets and some of the things in the economy that weren't useful. So, with that, I'll open this up for questions and discussion. Any of your final thoughts? If no other final thoughts, I'll just bid you good evening.